Hey guys, Jack Dickens here, just giving you your bond fund selection guidelines. That was my portion of the presentation, and I'll be giving you the tricks of the trade and how to choose what is right for you when diving into this sort of thing. So let's do it. First, when deciding what mutual fund to choose, you must think low expenses. My reading was very adamant in saying that the most important thing you can do if you're looking for earning competitive returns in a bond is to always choose the one with low expenses. And it also said that as a general rule, bond funds will have lower expense ratios than like more managed funds that invest in junk and other things. Secondly, you must stick with short, intermediate maturities. Over the past 20 years, the reading said, long-term fund bonds have provided the highest returns, basically because their interest rates have steadily declined over the period. You know that they have inverse effects, but that's always not the case. In addition, like long-term bonds can be incredibly shaky, volatile, it says. If interest rates rise by just 1% point, a bond can drop by more than 10%, wiping out a year's interest. So that's not good. So they're recommending that if you invest for shorter periods, say 10 years or less is what they're using at a cutoff, or if you're just buying bonds to add some mixture into your stock portfolio, which is predominantly stocks. I guess I shouldn't say stock portfolio, I should just say portfolio, but it is predominantly stocks, then you're better off with a bond with short to intermediate term maturities. So they advise in the reading 5 to 10 years. And they also said, quoting them directly, you can typically get 75 to 80% of the return of long-term funds while incurring roughly 40% less volatility. So that's very important to keep in mind. And lastly, beware of tempting yields. Mutual fund companies know that investors focus solely on yields, and they can sometimes have trouble seeing through the haze, and they just get swayed by the yields that they see. So some do everything that they can, in short, of putting off the fund on steroids to pump up the yield. So it's very deceiving. You look at the yield and you think, oh, this is great, but it might actually not be so. They may throw some low-grade bonds into a government portfolio or even invest in international bonds from countries where rates are especially high, just to trick you. And these sort of games that they're playing to boost interest may or may not pay off, but they all actually involve some sort of risk, and they're difficult to really break down and evaluate. It also said that a bond that's showing much higher yields than funds with similar maturities raise red flags. It's a telltale sign that someone is doing something different and much riskier. So there's a lot more risk involved when you're looking into very tempting yields. Hope you learned something.